Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of SNN or its affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. My guest on the show today is Mathieu Martin, the portfolio manager of Rivemont Microcap Fund. Mathieu is a microcap specialist who focuses on Canadian stocks. I've personally become fascinated with the differences between the US and Canadian markets, and I was excited to talk to Mathieu about where his love for microcap stocks began, the level of inefficiency he sees within Canadian microcaps, why US-based investors don't venture up to Canada as often as they should, what he learned after having a tough year in 2022, and just how cheap Canadian microcaps are at the current moment. And without any further ado, here's my conversation with Mathieu Martin of Rivemont. I'd love to start with how you initially got interested in microcap stocks.
Yeah, for sure. But maybe I can start with my background. So that will lead into how I got into microcaps. Both of my parents are entrepreneurs. My mother still is an accountant. She works on her own. She has her own small business, and my father also had a small business in the medical supply space. And so at a very young age, I kind of learned that you could become an entrepreneur and work on your own and be your own boss and do your own thing. So I got really interested in that early on, and I worked for both my parents starting when I was a teenager. And I went to high school. I went after we have a thing here in Quebec called Cégep, which is basically 2 years before going to college. And I did that for a year and a half, and I entered my last session not knowing what I wanted to do with my life. I didn't know what I wanted to study in college, so was a bit lost, and I decided to just drop out. A lot of people advised against it, but I had a hard time pursuing something that I didn't believe in, or I didn't have any long-term plan with it. So I went to work full-time for my father's business, and I was always looking for opportunities to do my own thing, become financially independent. And so I tried a few things here and there, and eventually, I stumbled upon poker. And I had one of my friends was playing poker, and he was winning, decent amounts of money doing that. So I was curious. I started playing poker a little bit. I started learning, reading books, and I had some participating on online message boards, things like that. And over the years, I was pretty successful playing poker. When I was still working for my father, but I won decent amounts of money through poker, and I was in my early 20s. I spent a lot of it on stupid stuff, but I was fortunate enough that at the end I was able to save some of that capital, and I didn't know what to do with it. I had no investing experience, no finance background. I didn't go to college. And one of my poker buddies was he actually had studied in finance. He had started investing in microcap companies a year before, and he kind of walked me through his strategy and why microcaps were inefficient, how you could develop an edge in this market, why as a small retail investor you could kind of beat the professionals, if you will. And so I got really interested in that. I jumped in right away. I bought like two microcap stocks that he recommended, and I started reading books, attending conferences, meeting other investors, just trying to learn as much as I could in those early years. So that was about 10 years ago. And took me a good 2 years to really figure out kind of my style, my winning strategy. I remember I started in 2014, and in 2016 we had a pretty severe bear market in Canadian microcaps, and that wiped out like 30% of my portfolio, like in year 2 or 3 of my investing journey. So that was very brutal. That was a hard lesson. I learned to basically I learned to focus on the margin of safety. I was investing in things that had no margin of safety at all. And so that's kind of how it began. And then after that, this friend that introduced me to microcaps and we started a blog. We started talking about some of our stock picks, and also I would write educational articles to help other retail investors learn more about the space. And we did that for a few years. I invested my capital as a kind of full-time job at that point. And then in 2017, we started looking at how could we start a microcap fund where we could pool some assets from mostly friends and family. So we partnered with an asset management firm called Rivemont here in Quebec, on an already established firm that was willing to give us our chance and start a microcap fund, which is now called the Rivemont Microcap Fund. And so that's how I got my start, if you will, in the investment business. I got my CFA after I joined Rivemont as a portfolio manager, and now I manage the fund full time.
I have to say that is one of the most unique entrance stories into investing that I've ever heard. And I have to ask a question about your background and the things that you've done and how it influences investing. How do you think poker positioned you fundamentally and philosophically for investing? I mean, I think there's plenty of analogies there, but I'm curious if you found that, or not. It's not necessarily as applicable as one might think.
Yeah, well, there are, I would say, two main things that stood out for me as I transitioned from, or things that I could apply from poker to investing. And the first one was, risk taking, or being used to volatility. So in poker, you can have pretty wild swings on day-to-day basis based on just luck in general. In the stock market, you see that same kind of volatility in the short to medium term. So living through that with poker, I didn't think that microcaps were especially like risky or volatile, because I was already used to it. Even though most people consider microcaps very, very risky and volatile. And the second thing is which is a bit related, is how to manage your emotions. So when you live through that kind of volatility, how do you keep a cool head when the market goes down? You have to think rationally and make good long-term decisions regardless of what's happening in the short term. So I think those are skills that I started developing through poker, and it probably gave me an edge in the stock market as well.
Yeah, I mean, it's funny to start your career in microcaps and then to look at other asset classes and be like, oh wow, this is really the one with a lot of volatility.
Yeah.
And so sticking on the microcap theme, a lot of our listeners may know a bit about microcap stocks that trade in the US. I think there's a perception that Canadian microcaps are all junior miners and totally speculative companies. So I'm curious about what the profile of the company that trades on the venture exchange, like a microcap company that trades on the venture exchange in Canada. What does that look like?
Yeah, well, actually, to a certain extent, it's true, the description you gave. So just to paint a broad picture of the Canadian market, it's heavily focused on natural resources. I believe it's about 2/3 of the market that is either mining or oil and gas. So that's actually one of the things that attracted me at first, because like the ecosystem in Canada, the brokers, the investment banks, the IR firms, everyone is so focused on mining, because that's the the largest sector, and typically, you know, these junior companies tend to raise a lot of capital. So there's good money to be made if you're an investment banker working with these companies. So it felt like the other sectors, like the technology sector, healthcare, industrials, things like that, were very overlooked, especially if you were like a profitable company that doesn't need to raise capital. So that's why I started looking more specifically at non-resource microcap companies.
And I think you mentioned that one of the first things you started to understand is the degree of inefficiency that exists in the microcap universe in general. And I'm curious about whether you think that there are specific tiers where, you know, at a certain level, maybe a 500 million market cap, you know, it's inefficient, but not, you don't see crazy things like you see maybe under 100 million. Do you see clear stratification of inefficiency, or is is it a little messier than that description would imply?
Yeah, well, I mean, it's not like totally clear cut, but there are some levels where you kind of unlock new pockets of new pools of liquidity, of capital that can invest in your company as you grow your market cap. So maybe I can just again just paint a broad picture in terms of market cap. In Canada, you have about 4,500 publicly listed companies. You have about 100 large caps, 750 small mid caps, and over 3,600 microcaps. And microcaps, I consider 300 million or less in market cap. So it's a very large pool of opportunities for me to look at. And typically, there's not a lot of capital chasing these opportunities because, as I think you know, and many people know, it's liquidity is an issue, is a challenge, especially if you manage a large fund. I mean, it's not going to move the needle if you invest like 0.1% of your portfolio into a microcap company. So the way I look at it, you know, I have a small fund, I have a small asset base. It's only 8 to 9 million in assets under management, so I can really play in the smallest companies possible on the Canadian market. So my goal typically is to find these opportunities below 100 million in market cap, and at that point, it's rare that you see any sort of institutional ownership. So it's mostly retail investors that kind of play in this space. And if let's say I invest in something and I'm right on the investment thesis and the company executes and they grow revenues and profits and they cross that $100 million market cap threshold, typically that's when you see you kind of unlock a new pool of capital that can invest in the company. So now you see other small institutional funds that tend to invest at that stage. And as you grow 200 million, 300 million, you have new pools of capitals that become available to invest as well in your company. So that's typically where you see the liquidity improving, the multiple expansion as well for companies that deserve it. So that's kind of essentially, if I had to pinpoint exactly the inefficiency I'm kind of exploiting, is I'm trying to find good companies, but I try to find them really small when there's no institutional ownership, and hopefully they become institutionally owned and you get that multiple expansion over time.
I think there's, for lack of a better word, alpha to be generated in any endeavor where you can sidestep or break down silos or mandates or rules like, well, I'm a US investor, I can't invest in Canada, or I can't touch a stock under 100 million because it's too small or too risky. And so anybody who can play in a sandbox that other people are prohibited from playing in, I think that's almost an evergreen opportunity. And so to getting to that point, I've spent a fair amount of time in microcap myself recently, and I get the sense that a lot of US public investors do not venture up to Canada to look for ideas. Is that something that you see as well? I mean, you talk about limited institutional coverage, but do you see, a lot of, are most of the institutions you see in Canada, or do you see US, some US investors also venturing up there more and more?
Yeah, well, there are a few institutional investors in the US that I know, like people I've got to know from MicroCap Club, for example. Some people look at the Canadian market because they kind of understand the opportunity set we have up here. But for the most part, I would say you're probably right that not a lot of US investors look at the Canadian market, or at least in the very small microcap markets. Like when you get up to 200, 300 million market cap, then you get some institutional investors from the US for sure. And my guess, if I had to guess, I think it's probably an issue with liquidity. Because otherwise, I mean, like the Canadian market, we have like strong regulations. We have the financial statements are audited every year. It's in English. It's the same time zone as the US. I don't see any like structural reasons why people would avoid Canada besides like it's just very liquid.
Yeah. What's been interesting to me is that where you haven't seen a lot of public equity investors venturing up into Canada, private equity has been really active, especially in technology companies in Canada recently. What do you think? What do you think people are recognizing on the private equity side about the opportunity set, and kind of the same one that you're pursuing?
Yeah, well, actually, that's a very good point, and something that's important to highlight since the middle of last year, 2023, we started seeing a lot of acquisitions of Canadian microcap companies by US private equity firms. I don't have the exact count right now, but it's probably like 15 to 20 transactions that happened in the last year. And I at the end of the day, I think US PE firms are smart money, and they see the opportunity. If you look at valuations, you always get a discount for being listed in Canada. It's always been like that. So I think PE firms look at their opportunity set in the US, and they just look north of the border, and you get everything for multiples cheaper. So I think people are starting to realize that, and there's been several acquisitions so far. To me, I mean, I think it's a validation that I'm at the right place at the right time. I'm fishing in the right pond. It's validation that companies are cheap, that you have quality companies as well in this ecosystem. I would rather have public investors realize that and build those stocks up so they remain public, because that's my sandbox. Like what we've seen in the last year or so, which is unfortunate, is that several high quality companies were privatized and now they're just out of the game. So for us microcap investors in the public market, it's a bit unfortunate.
And you mentioned that you have a limited capital pool intentionally, right, to be able to play in the smaller end of the market. And you talk about limiting the size of your fund to 25 million. Like what's the thinking about that number? What's special about 25 million that you think, why couldn't that be 50? Why couldn't that be 75? Couldn't you continue to run your strategy and invest in small companies at slightly higher levels?
Yeah, well, I mean, it's not a hard cap. It's based on my perception of when it will become more difficult to deploy that capital into my specific strategy, which is sub $100 million market cap companies. And the reason for limiting assets is because primarily because I'm a large shareholder of my fund. Most of my net worth is invested in the fund. My family has invested. My friends have invested. So it was mostly all friends and family when we started 6 years ago. and I want to keep the fund performing well. That's my main incentive, is to generate good returns, not necessarily gather more assets and make more fees. So I feel like at 25 million, I think it will become more challenging given the liquidity of the market to keep buying meaningful positions in these small opportunities. But then, it always depends on market conditions. I mean, if you had asked me this question last year when everything was super, super cheap, I would have said, I'll take as much as you want to give me. But if you go back to, let's say, early 2021, when everything was really expensive, liquidity was high, but the opportunity set was not very good in terms of finding bargains. So it would have been a good idea to take more money at that point. So it really depends on market conditions.
And you're not the kind of person who was reading Warren Buffett's letters at 14 years old and, absorbed all of that and had a philosophy already set about how to manage a portfolio. But yet you run a pretty concentrated portfolio of 15 to 25 positions. I'm curious about how you settled on that range as kind of the right numbers.
Yeah, well, actually, I'll just go back to the first part of your question. So you're right that I didn't read the Warren Buffett letters early on, and actually, not studying in finance, I think, was an advantage for me, because I started from a blank slate. I didn't have any preconceived notions of how the markets should work. I just tried to experiment and learn by myself in the market by testing my own hypotheses of what could work or could not work, and that's how I developed my own unique style, I think, and why I feel like my strategy is very differentiated from what you can find in other funds in Canada. But to get back to your question on the number of positions, I mean, again, it's not a hard rule of staying between 15 and 25, but you only get so many good ideas in any given year, and for me, I felt like I want to bet big on something I believe in. I want it to be meaningful, because I'm doing a lot of research prior to investing in something. And then, in terms of position sizing, we have a limit in the fund. We can't invest more than 15% in any one stock. So technically, I mean, we couldn't really have less than 6-7 stocks. I like to have some diversification as well. I think the sweet spot typically is 15 to 20 stocks. You're fairly well diversified, according to finance theory. But it depends again on market conditions. If you looked at our portfolio 2 years ago, we had, I think, 30 to 35 stocks in the portfolio, and now it's closer to 15, 18. So the bear market we had in Canadian microcaps in recent years made some opportunities really, really obvious to me that they were attractive, and on companies that I know well, that I've researched, that I followed for several years. I have a good relationship with management and I trust them. So at that point, I figured, let's just concentrate as much as possible on the ideas I really believe in. Whereas a few years ago, it was hard to find very attractive bargains. Like, you could find good companies, but they were typically fairly valued or overpriced. So that's why at that point, I was more diversified. I was trying to spread my bets a little bit more.
I see that you have almost 2/3 of your portfolio in the top 5 names. What are the characteristics of a company that makes it into that top 5?
Yeah, well, so yeah, going back to concentration, I mean, like the largest position we have is over 20% of the fund, and top 5 right now is about 62%, I think. So very concentrated at the top. And these companies typically, I mean, well, I'll just start with my criteria. It will give you a flavor of what I look for. So I'm not reinventing the wheel in terms of criteria. What I look for are solid businesses. I have a bias for growth. So I want companies growing 20 to 25% or more. I want a company that's profitable or very close to profitability, good balance sheet, good management team that I can trust, that's competent and honest. And then I'm looking for an emerging mode, emerging competitive advantages. And I say emerging because typically in microcaps, you won't find like a super solid mode. Like you won't find a network effect like a Meta, for example. But if they dominate a specific niche or they have some specific thing that they're doing differently that I think is maybe a better mousetrap, and I think they can gain market share that way. That's kind of what I'm looking for. I'm just trying to avoid any commodity businesses. And then when these companies fit my criteria, it's a matter of valuation. So how I'll build a portfolio is if I find an attractive business, but it's not at an attractive price, I'll either keep it on the watch list or I'll buy a small starter position, typically 1 to 3% of the portfolio. And I'll be looking to add to it at some point in the future if the opportunity presents itself. So the companies we have in the top 5 right now are, for the most part, businesses that we've held for a long time, and at some point they got discounted for some reason. One example could be, I can give you a couple of examples.
Sure.
There's one called Kraken Robotics, PNG, on the TSX Venture. We still own the stock, and we've actually held the stock since almost since the beginning of the fund in 2018, and it was for the most part a small position. But last year, if you look at the stock chart, the stock started the year at about 65 cents, and it went down to 35 cents over the next few months. And what happened was the founder retired, and he held about 10% of the company's shares. He exited the board, he exited the management team, everything, and he just started selling in the market very aggressively. And the company has been growing like revenue per share at so including dilution at 40% CAGR for the last 5 years. They're EBITDA positive. They have a good balance sheet. They have a good management team. Tailwinds in their industry. They have a moat. Everything's going well. And then you see the stock price getting cut like almost in half. And I would talk to the management team, and they would say like, business is doing well. We have this guidance out there for the year. We're still on track. Like everything's fine. We don't know why he's selling. And so to me, that was an opportunity. And, at the bottom, you had this company with these growth metrics I just mentioned that was trading at 4 to 5 times EBITDA, growing 40% CAGR with a good outlook for the future as well. And that's when we significantly increased our position. And at the end of the day, it worked out. I mean, there was nothing wrong with the business. The stock rebounded, and it became our largest position sometimes last year and early this year. So that's one example of like there was a structural reason why it got discounted, nothing to do with the business, and we were able to take advantage of it. Other times it can be just a business that's been totally undiscovered, under the radar. Like sometimes this happens when it's a turnaround. Maybe you have a new management team, like the business does poorly for like 10 years. Everybody got burned on it, and then new management team comes in, they restructure the business. Maybe they put some capital into the business as well to have skin in the game, and then they just put their head down, work on the business for several years. No IR, no promotion, no anything, no liquidity on the stock, and then we just find it great business, great financial metrics, totally undervalued, and hopefully, after we buy it, we try to increase their capital markets profile a little bit. Maybe we write it up on MicroCap Club, or we talk about it on podcasts, or we share our research with other investors and try to get the company discovered over time. So the fundamental value is reflected in the stock before maybe it gets taken out by US private equity firm, for example.
I always like to ask people why a high quality growing business with a moat would ever trade cheaply. And the thing about microcap that you don't see up market cap is that you don't see a totally non-structural, no non-business reason why a stock would get cut in half. Right. But in microcap, that's the opportunity set, is that there are these things that happen that are not that have nothing to do with the operations of the business. So you actually answered one of my favorite questions, and I think it's a good example of why microcap's so interesting. I think when you think about Kraken, I think putting on my allocator hat for a moment, my first question would be about sell discipline, right? It's risen to 20% of the portfolio. It looks like, my guess is it's more fairly valued. How have you thought, how do you approach sell discipline in general? And maybe Kraken could be a good example of how you try to mitigate risks in the portfolio.
Yeah, for sure. Actually, it's a very good question. And Kraken was in the early part of this year. It was the top question on my mind. What should I do with our large position in Kraken as it got closer to fair value? Let's say. So like in terms of risk management, of course, like having a twin. I think at the peak it was probably close to 30% of the fund in that one position. And our clients, are high net worth individuals. They're not institutions. So maybe they have a bit less tolerance for volatility compared to an institutional allocator, for example. So I have to think about that and make sure we don't get cut in half on our largest position, for example. So I thought a lot about the downside risk on that one specifically. On the flip side, you always think also about what is the upside that is left on the stock, because it started the year at 65 cents, ended the year close to $1, I think, with all that volatility in between. But at the end of the day, the business grew a lot throughout the year. Their EBITDA increased a lot as well, and so you could justify that from 65 cents to $1. Like, you didn't get like a super big multiple expansion or anything like that. It was just like business performance was good. So do I still hold it at this point? So yeah, it was a tough decision. At some point, I decided to reduce because they had a large. So I don't want to get too much into the weeds, but this company sells equipment that goes on underwater drones. They sell to the military mostly, and they had a big RFP, a big bid that they submitted for a military program in Australia, that investors were hoping they would win, and were awaiting a news on that front in the first half of this year. And I saw news out of Australia that the program had been canceled. So I reached out to management and I said, this program that you're bidding on has been canceled. What's happening? And they said, yeah, they're reshuffling their budgets. We still think we'll get that business, but maybe it's going to be in a different form, maybe a different timeline. We're still confident, but it's not happening under this program. And I think I was probably one of the first person to realize that this was happening, because I know the stock so well and I follow the business so closely. And at that point, I figured, if the market gets aware of that, and maybe over the next few days, it will, like, the information will get known by the broader market, I think investors will react badly to it. So at that point, I decided to trim my position by 40%, to bring it at 15% of the portfolio instead of 25-30%. And that night I slept well. I felt like it was the right decision. So I guess that was an okay decision.
That's an interesting story. And so you mentioned your clients, and you mentioned illiquidity and volatility, and that are kind of endemic with microcap companies. So my guess is, as you said, is stocks often move up and down, almost irrespective of what intrinsic value is doing. So how do you coach your investors, or what do you tell them to expect about the volatility of returns? Because it sounds like these people don't necessarily have the institutional mindset. Like, this is, this is microcap, this is going to be the way it is, and we underwrite that very gladly. So what's the education process? What do you tell people to expect in your portfolio, which is pretty concentrated?
Yeah, it's probably the most challenging part of my job, is to get people to understand how volatile it can be, especially if you're not a finance person. Like, typically people tend to be attracted to a microcap strategy because of the high potential returns, regardless of the risk or the volatility that's involved. And so I always tell people, like new prospective clients, I tell them, like, are you okay with a drawdown of at least 30% in your portfolio? At least. Like, it's gonna happen. I'm telling you, it's gonna happen at some point. You lose 30% in a year. Are you okay with that? And typically they say yes. Then it happens, and maybe they were not okay with it. So it's always hard to tell in advance. But I always make sure I explain it, like, really clearly, that it can happen. And like, if you look at our returns over the last few years, the Canadian microcap markets, if you look at the TSX Venture Index, it peaked in March 2021, and over the next 2.5 years, the index declined 52%. So that's been brutal in the market, and our fund did similar. Like, the drawdown was about 50% as well in our fund. So I mean, it's very significant. I mean, it's tough for investors to stay invested at that point, because they feel like people were calling, like, am I gonna lose everything? Am I gonna go to zero? I was like, no, these are real businesses. Like, we own real businesses that generate cash flows, and they have a good balance sheet. They're not going out of business. Don't worry. But like, if you're not involved on the day-to-day, and you know these businesses inside out like I do, it's really hard to keep the conviction to hold a fund like that. So I mean, those who held throughout this volatility, I mean, kudos to them. And unfortunately, some of them got out at the worst time.
In that response, you mentioned the tough period that Canadian microcaps had, in the kind of 2021 to 2022 period. And you also mentioned the tough returns that you guys had. I'm curious if you learned anything meaningful about portfolio management and construction as a result of going through that period.
Yeah, well, I think the main lesson for me was, like, after the fact, I realized that I didn't stick to my criteria enough. It's hard, because when the market is really doing well, like the rebound we saw after the COVID crash, we had a very significant rebound in late 2020 and going into early 2021. Liquidity is super high, like lots of trading volume, lots of activity. Companies are announcing financings left and right. You have bought deals, financings everywhere. Like, the investment banks are reaching out with new opportunities every day. It was like crazy, and everything seems overvalued. But then you look at an opportunity, you look at their peers to try to base your valuation on something, and everything's overvalued. So yeah, maybe 7 times revenue is not that bad, because all the peers are trading at 10, 15 times. So you start to compromise on some criteria, or maybe I invested in something that wasn't profitable yet, but it's okay, because there's so much money in the market right now, they're going to be able to access another financing in 6 months. Well, turns out it did not happen because the market crashed and liquidity vanished. So I wouldn't say I changed my strategy totally. I mean, most of the portfolio was still invested in what I consider high quality companies that were profitable. But I think in some cases I went a bit more speculative than I should have on some opportunities. And maybe there were a few positions that we owned that got really, really overvalued, and I should have sold at that point, and I didn't because I'm a long-term holder. So I wanted to hold for long term, and I missed the opportunity to cash in on significant gains that I could have reinvested later at better prices. So those were kind of the lessons. Maybe listen less to what's happening in the market and just stick to my own formula.
I think a lot of people and very successful investors faced a similar situation in 2022. Some need to be mostly fully invested, but finding very few bargains and having to kind of just play the relative game. Well, this looks cheap. It's 7 times revenue versus something that's trading at 40 times. So, I think those are lessons that, were easy to learn, but really, mistakes were hard to avoid during a period like that. So you mentioned being a long-term holder. I'm curious about, these are liquid positions. It's hard to get in, it's hard to get out. I'm curious about your targeted or ideal hold period for these companies.
Yeah, well, I would say, I mean, I consider myself a long-term holder. Some of the positions that we own today, we've held since the beginning of the fund in 2018, so more than 6 years. But what I like to say is I will hold companies as long as they execute. So as long as the investment thesis is valid, I think it's undervalued. I think I still like the management team, and I think the growth prospects are still attractive. I'll try not to touch it too much. Of course, sometimes I add or trim based on the valuation and the relative opportunity set. But overall, the large positions we own, I tend not to touch them too much.
And when you sell out of a position completely, as opposed to just a trim, what's typically causing that, especially if it's a position that's in the top of the portfolio? So, I mean, my own sense and my own knowledge is that some weird things happen with small companies, and just very different than investing in mega caps in terms of just the volatility of things that can happen. So I'm curious, like, when you've had to sell out of larger positions, what kind of things are driving that?
Yeah, well, maybe I'll break it down into 2 buckets. You have the large positions, like top 5 positions, and then you have the smaller ones. The smaller ones, there's a lot of turnover in those positions, because typically, it's either a starter position that I would like to increase over time as I build conviction, or as the valuation changes. And the other thing I would put in there is what I call like re-rating opportunities. So I find something that's like 50 cents on the dollar. I think it's just too cheap, and maybe there's a catalyst that will help the market discover it, and it will maybe double in the next 6 to 12 months. So I invest in some of those as well. So you can see how there could be a lot of turnover in that part of the portfolio. The larger ones, they don't change a lot. When they change, it can be for a few reasons. One example is an acquisition. So one of our top 5 positions this year was acquired in January. So it was a 12% position that got acquired for a 30% premium. So we got a 15% cash infusion.
Yeah.
That I had to redeploy into other opportunities over time. So that created a big hole. Other than that, it can be just something becomes crazily overvalued. I can give you an example. Several years ago, we invested in a company called Xebec Adsorption. based here in Quebec. They're no longer public, and I don't own it. But we found it at a 40 million market cap, and the company executed. They posted strong revenue growth, and they were in the clean tech sector, which was very hot at the time. The company got discovered, their market cap increased, their liquidity increased, and the stock went up to almost a 2 billion market cap over the course of about 2 years.
Wow.
And it started from 0 analyst coverage to, I think, 12, 15 analysts covering the stock. Went from 2 times revenue to 10 times revenue. It was 0 institutional ownership. It went up to, I don't know what percentage, but a large portion of institutional ownership. It was included in some indices. So at that point, I was like, there's no point holding this anymore. It's crazy overvalued. It's discovered. The liquidity has improved. The market cap is way too big for our strategy. So that's when I decided to exit the position. So it was to date it's still our biggest gain.
Wow.
In the fund. And the other reason is when an investment thesis doesn't work out. I was wrong. Things didn't pan out as expected, but I mitigate that by position sizing. When I increase a position and I get it up to a top 5 over time, it's because I build conviction that the investment thesis is playing out as expected. So I would say, I mean, I can be wrong, of course. Like, I'm not saying I'm never wrong, but typically I try to de-risk it that way. And if I feel like my investment thesis is not working out, it's rare that I would completely sell out of like 10% position right away. Like, I would probably reduce it back to a smaller one and then reassess and then maybe sell completely over time.
When I look at the portfolio of whatever 15 to 18 positions, I see a fair amount of concentration in industrials, IT, healthcare. Is that by design where you feel you're strongest, or is that more of an outcome of the opportunities you're finding?
Yeah, well, it's more a matter of sticking to my criteria, and the companies in those industries tend to fit my criteria better. I mean, the only thing I avoid is anything that's natural resources related. So, as I said in the beginning, about 2/3 of the Canadian market is natural resources related. So I avoid 2/3 of the market right off the bat. And then the last third, I will look at pretty much anything, as long as it's growing, profitable, as a mode, some kind of mode. So I tend to avoid biotechs because they have no revenue, for example, or pre-revenue technology companies I avoid as well. So I can narrow it down to about, maybe 200 or so companies that I actively follow. And those tend to fall into technology, healthcare, or industrials most of the time. But like, just to give you an example, we recently bought a position in a cannabis retailer. It's totally out of my circle of competence, I would say. But initially, I mean, I didn't really look at it, but my analyst found it, and it was like, I like the business model. Their business model is really interesting. I think they have a strong moat in Canada for this particular reason. And he explained me the thesis. I was like, well, that makes a lot of sense. And like, it's not in an industry we typically like to invest in. Actually, I don't think we ever invested in a cannabis-related company since the inception of the fund. But now it made sense. The company was growing, profitable, good balance sheet, checked all the boxes, so we invested.
And you mentioned the 200 companies that you guys are following. I know you have a small team. I'm curious how you divide up the work and the model updating and obviously you're on top of your ideas if you recognize the Australian military cancellation of that program. So I'm just curious how you efficiently follow all of those companies well.
Yeah, well, so yeah, it's a small team. It's me and my analyst Philippe Lapointe. So just the two of us. The way we tend to split responsibilities is I feel like I'm more top of the funnel. So on a daily basis, I will skim through all the press releases on the Canadian market every day. I look at all news releases and all financial statements that come out. So it's typically 200 to 1,000 filings per day. I will skim through the headlines. What I'm looking for is there a new company name that I haven't seen before? Because I've been doing this for a while, so I know most companies now. But is there a new name? Maybe it's a new listing that maybe I should look at. Or is there a headline that catches my attention? Maybe a company won a big contract, or maybe they publish financial results and there's strong revenue growth, or maybe a company that's been unprofitable for several years turns profitable. So there are a few things like that that I'm looking for that show that the company is executing on its business plan. And when I find something that looks attractive, I'll pass it on to Philip, and Philip will do the bulk of the research on the company. Speaking with management, building the financial model, and all that stuff. And if he finds, at the end of the first round of research, if he thinks it's an attractive idea, then I get re-involved again, and then we do maybe a second management call. We look at the assumptions in the model together. We build a valuation framework. We look at the risks, all that stuff, and once it becomes a position in the portfolio, I try to stay in touch with management. Try to stay in touch with other investors as well, or if they're covered by an analyst, for example, I'll stay in touch with the broker or the analyst that's covering them to make sure I'm on top of the news or anything that's happening with the company. So I would say I'm more involved high level, and Philip is more in the weeds doing the research.
I have this thesis and hypothesis that I'd love to test on you, which is that if you take a step back and listen to what you just said, you're going through press releases by publicly available information that says something is happening, an inflection point of some kind, continued execution that would, merit some kind of re-rating evaluation. But yet it seems like you believe that even just the process of reading through those press releases and the fact that they're public doesn't necessarily move the stock, or it doesn't impact the stock. So I have this idea that microcap's not that different from large cap and other areas, where if somebody executes really well for a long period of time, stocks are going to go up. It just, for me, my sense and what I've seen that, through our research, is that you just have a longer period of time to discover something. Because if a big company issues a big press release and wins a contract, right, the stock's going to react immediately, right? There's no question about it. That's the market efficiency up the market cap spectrum. So is that part of the idea, is that you just think even if it's already out there, it's unlikely to be fully appreciated, and you can actually then dig in and have time to do the research before everyone else discovers this thing?
Yeah, it's crazy to the way you put it. Like you would think it's crazy to expect that this is how it's going to play out, but that's really what happens. There's a big lag between when news is released and when it gets priced in, or sometimes it gets totally ignored. In some cases, depending on how obvious the news is, the market will react more quickly. But like a few years ago, I'll give you an example. It's a company. I won't name the company because it's not relevant, but it's a company I had been following for a long time, and they were struggling for most of the time I was following them. They were unprofitable. They had a terrible balance sheet, like a lot of debt, like maybe like $30-40 million of debt on a 5 million market cap. They were about to go bankrupt. But I had spoken with management. I knew the business. I knew what they were doing and maybe what was the potential moat. And one day they put out a press release and they say we are restructuring our debt, and the lender agreed to write off like something like $35 million in debt for a $1 million payment. That's it. And so they will avoid bankruptcy and all that stuff. And so I'm like, well, now this is crazy cheap. Like, this doesn't make any sense. Like, you had a $40 million enterprise value before, and now you have a $6 million enterprise value after the settlement. So it needs to re-rate. And so I buy the stock at the open, the first thing in the morning. I buy the stock, and then it goes on to quadruple over the course of the next few days. So like, I was able to buy stock because I was kind of the first one to realize what was happening, and then people figured it out over the next 3, 4, 5 days, and the stock went up 4 times. So like, it blows my mind when I think about it.
Stories that you never hear outside of microcap. That's I mean, I think that's the evergreen nature of the microcap space, is that there's all these idiosyncratic situations and stories and lack of liquidity and what the selling shareholders are doing. And it's just like you get these pockets of time and inefficiency where you can take advantage of inefficiency, but you have to stay small, and that's the trade-off.
Yeah, and the other thing, I think it has to do with the time horizon. Like, typically, I think large caps, when they trade significantly up or down on news, I think it's more maybe short-term money that's coming into these stocks and causing these moves in stock price. But if you look at microcaps, typically, like, a company can release a good fundamental news, but maybe they're at the beginning of a turnaround and they're getting some traction, but it's going to play out over the next 2 years. So you won't have like these algos or hedge funds that will get into these stocks right away, hoping to exit next quarter. So that's why I think you have more time to do the research properly and really build your thesis around the company and invest way before it gets discovered by larger pools of capital.
What I think is really compelling about what you're doing is you're playing in an inefficient market. You screen out 2/3 of companies immediately, and you probably screen out another half or more based on profitability and a couple other metrics. And so you're really fishing in a pond that remains inefficient, that kind of has the taint of what the perception of the Canadian venture exchange is, right? But yet there's real businesses in there that nobody else is looking at, and I don't know what's structurally going to change that. So I think, I mean, if you're willing to stay small, if you're willing to continue just to play in this world, like the compounding, the opportunity to compound is going to be basically evergreen for you. So with all that as a backdrop, I'm curious, if we're having this conversation 7 years from now, what would success look like to you in the Rivemont Microcap Fund?
Well, in terms of numbers or metrics, I would say, reaching that $25 million in the assets under management threshold would look like success to me. At least 25 million, because that means my capital raising efforts have been successful, or maybe we grew the assets organically through the returns as well. But then I would probably be happy to cap the assets there and just let the strategy compound for early investors. In terms of the return profile on the fund, as I said, the last couple of years were really challenging for Canadian microcaps. So the compound return since inception of the fund is around 6% right now. It's net of fees, by the way, and it's beating the benchmark. But I don't. I'm not pleased with that. I feel like a strategy that's so risky, so volatile. I think just if you compare with other asset classes or other ways how people can invest their capital, I think 6% for such a strategy is not sufficient. So I would like the return profile to be much higher in a few years as the asset class recovers. And then for me personally, I would say, if in 7 years I'm still really passionate about the microcap asset class and still driven to learn more and improve myself and improve my decision-making skills. Basically, if I'm still as motivated as I am today, I think it's going to be a big success. And I'd love to be able to say that in 7 years.
When you think about the return profile that you just gave for the benchmark and your fund over that period of time at 6%, I can't imagine a stat that would suggest more strongly how undervalued the whole space is now, especially relative to everything large, everything US, right? Like, that just, it seems to me like that's a function of valuation, right? As opposed to some kind of permanent impairment of the entire asset class. So, I mean, it's an interesting data point that it'd be interesting to talk about this 7 years from now and see what that number is, regardless of how you guys do, but let's see how that index does. So we're going to close with our favorite question, the question we asked all our managers. We really talked about inefficiency and the pool you're playing, you're swimming in, and all of that stuff. So I think people get it, but I guess I'd love your own narrative on, like, what do you think the most underappreciated aspect of the investment opportunity set you have in front of you is?
Yeah, well, I mean, to your last point, I think valuations are really cheap right now in Canadian microcaps. If you look at just compared to historical averages, or if you look relatively to other asset classes right now, mainly large caps, I think Canadian microcaps are very, very undervalued. So I think that's probably something that most people don't realize or don't appreciate as much as they should. If you look also at liquidity and financing data, which the TMX group, the owner of the TSX and TSX Venture markets, they put out every month their monthly data on trading volume and financing activity, the capital raising activity from listed issuers, and on both fronts, it's way below the historical averages. I compile like the data for the last 15 years, and I think right now we're 30 to 40% below the 15-year average in terms of volume and financing. So basically, nobody cares right now. There's no institutional capital in the space. There's no volume, no financing. Nothing's happening. And at this point, it feels like there's only one way it can go, and it can improve. I mean, things can always get worse, but I have a hard time seeing how it could get worse than that. So I feel over the next few years, we'll see more institutional capital coming down to this space, probably because of valuations. And then we'll see improved liquidity, improved financing, and then it could become a positive flywheel where we see the asset class really re-rate and perform extremely well. So, of course, I'm biased, but that's kind of my outlook for the next few years.
Well, I'm biased now, but I have come into the microcap space as kind of a tourist and formerly just an observer. And it is without question that when I compare the microcap universe in the US to the opportunities, like the quality of businesses we can find in Canada, and obviously we're doing the same screens you are, but the businesses that don't fit the profile of the natural resources and biotechs and non-profitable, just seems like you get just a big difference in valuation, even with it compared to US microcaps, not to mention like whatever larger companies. And that's I think that's why private equity is excited about this space. And for sure, like it wouldn't surprise you to hear that there's a number of companies in Canada that are on our list of things that we're working on too.
Yeah, well, don't take them out too early. Leave some of the good ones for us, Ben.
Thankfully, there's a big enough universe. Well, Matthew, this has been incredible. Thank you so much for this overview of the Canadian market, and then specifically the focus on the microcaps. And I just don't think this is an asset class that people think about. But I mean, it's like, there just aren't that many in North America. There aren't that many, I think, truly inefficient markets left, right? In equities, right? You can talk about lower middle market private equity in the U.S. and Canada. You can talk about microcaps in the U.S. and Canada, but that's really about it. And so if you think about where people are going to generate returns from, you can't put a lot of capital in this space, but but I do think the dollar returns are going to be really attractive going forward. So wishing you luck, excited for the opportunity set in front of you. Thanks for being on the show.
Well, thanks a lot, Ben. I'm a big fan of your podcast, and it's been an honor to be invited. So thank you very much, and I enjoyed the conversation.
Likewise. Thanks again.
Matthew mentioned a number of securities on this podcast. I do not own any of them.